coupled with the good news about doubling the amount of vaccines we're going to get, stimulus continuing, and sort of, an acceptance of what's going on with the 10-year, I think is bringing some positive momentum to the NASDAQ.
KBW Banks Index higher, but off the highs of the session after the Fed announced plans to lift its pandemic restrictions on buybacks and dividends by June 30th, up about 1.3% or so, but I guess not much ahead of the broader markets. And as we discussed yesterday, unlikely we'll see a massive unleash of buybacks because bank stocks have rallied so much. We might see more of an increase in dividends from here, but it will vary from stock to stock. Some banks still a little cheaper, like Wells Fargo and Citi, than others, like Morgan Stanley and JP Morgan. Sylvia, what's your take as to whether or not this is a nice additional bit of positive news for the banks, or something more significant, more game-changing?
I think it's a nice point towards the idea of the reopen and recovery of the U.S. market. So, these regulations went into place to avoid a 2008 and perhaps to avoid some selling of treasuries and sort of mitigate some of that volatility in the market. But I think what we see here is that banks have been resilient in sort of the sharpest and potentially shortest bear market that we've seen. And this tells me that, banks are in a good spot now, right? They're paying you 0% on your savings, but the 10-year going up a little bit allows them to charge, something on loans. So the margin is sort of growing there. And, 0% on savings, maybe you take your money, put it back into the banks and receive some of these higher dividends too. So I do think it's generally positive for the sector.
Well, how did the charts look? They must look positive. The sector's up, 16% so far this year, Chris? And if so, any of them look particularly attractive to you? Names?
Yeah, here's what I think is interesting. I want to distinguish between what they've done in the short term and what they've done over the longer term, because yes, all the bank stocks are up meaningfully over the last 6 or 7 months here, but a lot of them have made no progress since 2004, 2005, 2006. So we look at these as coming out of these huge bases. They've been in purgatory for 15 years. Look at the long-term charts of the Goldman Sachs, the Bank of Americas, the U.S. banks. These are good-looking pictures longer term. And I recognize that flows are probably too aggressive in the short term. Maybe they pause or consolidate here. You have something like 98% of them above their 200-day right now. So they can pause here, use weakness opportunistically. This is a group coming out of a 15-year range. We like that.
What's your outlook, Chris, on rates? I mean, clearly for some of the retail banks, the shape of the yield curve and the height of it will be relevant. What's your outlook for the yield curve?
Well, what's remarkable, and we've talked about this before, if you look at where the street economists are, there are 62 Wall Street economists who submit their yield forecast to Bloomberg every week. There's only 3 of them with a 10-year yield forecast above 2% for year-end 21. That just seems like all the economists still have to move the forecast to the right side. So we're looking for something north of 2. That's been our call. I think in the short term, yield want to pause here, but I think when you're looking out 3, 4, 5, 6 months, something north of 2% is where we're going.
Session highs here as we go into the close, less than 10 minutes away. Fintech company SoFi saying it will allow retail investors to buy into IPOs. Kate Rooney with the details. Kate.
Hey, Sarah, SoFi is really breaking with Wall Street tradition here. These IPO shares are usually set aside for institutional investors or high net worth individuals. The startup will now offer early access to its clients. SoFi will be an underwriter in these deals, working with companies to buy securities from the issuer, then selling those back to its retail investors. Robinhood is also reportedly working on a similar product, but declined to comment. We spoke to CEO Anthony Noto this morning. He acknowledged the risks that come along with some of these earlier stage companies. He likened it to crypto investing and says SoFi issues adequate warnings. Guys, back to you.
Kate Rooney. Kate, thank you. Sylvia, do you like this? It sounds good, opening access to retail traders from something that was formerly cut off.
Yes, Sarah, I love it. I mean, I love the idea that we're sort of democratizing access to large institutional hedge fund type like investments to the average retail investor. And I also think that the retail investor has made their, his or her voice super clear this year, and they're looking at emerging and disruptive technologies. So what you're finding with the latest IPOs and the latest SPACs on the market is just that. That's the best way to get access to these names. And if you look at the profile of these investors, they're younger. So like, yes, this is risky. We'll sort of see which IPOs do well, which SPACs do well and merge, but they have the appetite and they have the timeline. And I think if they hold on and have these opportunities in their portfolios long term, they may be rewarded for that type of investment. So I love it. I think it's a great addition for the market and for trading platforms.
Chris, more broadly on the retail investor, are we seeing any signs of their involvement pulling back? And what do you think it might do to markets if that does occur?
Yeah, what's interesting is, I would say, let's not forget, it's been 20 years before retail has actually even been involved. So this is a new thing. We haven't seen this since the late 90s, early 2000s. I would agree, maybe we're in the first or second inning of this, but I keep thinking about who's the loser with all of this stuff? And maybe it's the bond funds, right? Retail has been camped out in bond funds for the last 10, 11 years. I think as bond yields go up, we're always asked, at what level do higher bond yields hurt stocks? I think that the right thing to ask is, at what level do higher bond yields hurt bonds? And maybe it's why we're seeing some of the bond surrogates or bond proxies in the equity market start to act better. So I think what you're seeing is retail move away from fixed income, move away from money market funds, and get back into equities. I think the second inning here.
So you see the sell-off in bonds continuing, higher yields? How high do you think the 10-year gets?
Yeah, I think we see something north of 2% here. As we probably have all seen, bond yields never go precisely where you think they're going to go. I might take the over on that, 230, 240. Let's not forget, we're only 2 years removed from the 10-year yield at 3.25 in October of 18. I think what was interesting was when bond yields were going up in the fourth quarter of 18, defensives were actually leading. That was the market saying, whoa, yields have gone up too far here. It's time to get defensive. We really haven't seen that yet. I think as long as the leadership framework of this market stays pretty cyclical, I'm okay with bond yields drifting towards 2%.
Let's quickly check markets with 5 minutes left. Session highs 340 now on the Dow, over 1% for the Dow, 1.3 for the S&P. The Nasdaq's up 0.8, and in fact, almost all of the sectors are higher. 10 out of 11 now. Just communication services lower. Tesla rival NIO is the latest automaker to suspend production due to the global chip shortage. The company also cutting first quarter delivery forecast to around 19,500 vehicles versus the 20,000 to 20,500 previously expected. NIO shares down 5% or so today. Sylvia, what is your take on this? I mean, is this going to hurt the EV makers more than traditional automakers, or kind of everyone equally? And who's going to be hit most in terms of share prices off the back of it?
I think in the short term, between the 10-year and this story on the shortage of chips for the EV car maker, it's detrimental. I think the amount of production that they're going to have in the short term is going to sort of change the overall estimates that they had. But what this tells me is that chip makers need to create more chips. There's a high demand for EV batteries. And, these cars are essentially going to have a backlog and be in massive, rapid production growth space. So when I see Tesla at this price, I get really excited about it. I think about the future and all of the policy going into becoming carbon neutral and sort of moving towards electric vehicles. I think it's a short-term issue. And I think that, investors looking to get in on some of these names, I mean, there's certainly a discount here.
Let's talk about Tesla, Chris. I was going to ask you about this chart. Anyway, It's not participating in this surge into the close, where the S&P is now up 1.5%. It's one of the worst performers, down 3.5%. I think the weekly low on Tesla is $600. So we're not too far from there, but it has been breaking down lately. What does it tell you?
Yeah, I think there's 2 points here. I would say, number one, Tesla has certainly been